Peace, everybody. Welcome to Trust Fund Baby ACT, and we have two special guests, our brother Jay Ali, and we are bringing back brother Jerron, the creator of T Loan, The Life of a Negro Project, and many more. And yeah, I'm about to say let's get into it. Today we also will be featuring certain information that we would like to highlight, such as the book of the week. The book of the week, it is by Edward Thorp. It is How to Beat the Dealer. And Edward Thorp, they made the movie 21 about that individual, but we're gonna get into these subjects later on. And then we have our company of the week, which is Citadel, which will I for sure want to hear Jay insight and brother Jerron on those particular companies. And brother Jay, he gave us the movie of the week, which is The Big Short. So we will be touching on all those subject matters. And today, our main subject will be the crypto correction. So without further ado, let's bring on our guest on board. Boom, boom. Peace, peace, peace. What's going on, people?
Peace, what's going on?
Yo.
So, um, first, Edward Thorpe, because we're talking about market and risk management and things like that. That's the reason why I wanted to bring his book up as the book of the week, How to Beat the Killer. That right. I feel like that particular book was life-changing to the stock. And I would like to get you all insight on that particular information if you don't mind. Jay, I know you familiar.
Edward Thorpe. So long story short about Edward Thorpe. Edward Thorpe was essentially a quant before people were called quants. His strategies that he used were based essentially on accurate pricing of risk, taking into account probabilities and also the potential risk return. So he was the originator, not necessarily technically speaking, but foundationally speaking, for a lot of the metrics that we use today, such as value at risk, and just risk adjusted performance overall. And the reason why Edward Thorpe is such a big deal was because in his blackjack time, he was one of the largest proponents of what's called the Kelly criterion. So the Kelly criterion is essentially a mathematical model that you use to accurately suggest what your position size will be or the amount of your portfolio that you want to put up as stake in a specific bet. And it's based on the probabilities of you being correct, and it's also based on the potential risk reward. So the Kelly criterion is something that's very widely used for investors that have a more concentrated approach to portfolio management. So if you look at Berkshire Hathaway and Warren Buffett, for example, they use what's called the fractional Kelly, which means that they take the Kelly criterion, and because they deal with such large amounts of assets under management, they might not use the outright Kelly number, but they use a fraction of it in order to choose their position size and in order to leverage in. There's actually a great research article that he did in December of 1992 called The Kelly Criterion in the Stock Market. You can find it on edwardobthorpe.com. He did it for the American Mathematical Monthly. And in that, he went over the Kelly Criterion and how it applies to the stock market with Lewis M. Rotando and Edward Thorpe. And once again, he's one of the preeminent figures when you talk about risk management in the markets. He started off in blackjack. His methods in blackjack were so advanced and so thoroughly fruitful, so to speak, that in using his methodology, he was clearing out a lot of the blackjack dealers. He actually got banned from gambling at a lot of places. And then once he got banned from that, he then decided, hey, now I'm going to go ahead and enter the markets. And he started up a fund that has been very successful with the same principles that he used in the Beat the Dealer book. So Edward Thorp is definitely a great person to read about and be aware of.
Bro. So well, I'm gonna have to bring you on a lot more. I hope you get comfortable being on camera because you're not leaving. Like you good at this. You're not for real. It was like you comfortable with what you know, and that's really all it takes, bro. Yeah.
So let me pose a question with that. So how do we feel about quants coming from popular culture? Let's just say the casino realm, right? Of people, perfecting their algorithms, you know what I'm saying, inside of, popular culture before they bring it into the market.
What do you mean by popular culture exactly?
No, I'm just saying the casino realm, right? So like if you look at it,
Oh,
him
you mean like
perfecting it.
people that do card counting and stuff like that?
Yeah, so like Dirty Goth Boy, I think his name is Michael Mace. He's like the
I
new
think it's
version of it.
overall frowned upon just because of its level of efficacy.
Yeah.
You know, the casinos aren't looking for you to be effective. They're looking for you to be inebriated, come in there and lose your money.
Yep.
So they don't look on quants too fondly. Um, Even in the markets, you know, there's a lot of sections of the markets that don't look on quants too fondly. I think a lot of that comes to do with data literacy because
Yep.
at the end of the day, all a quant is somebody that's using mathematical and statistical methods to inform their investment process. So if you look at what it would be in other realms, instead of a quantitative trader or a quantitative researcher, they would call it a data scientist or a data engineer or something to that effect, maybe a data analyst. And even if you look at a large variety of countries, not countries, but companies, I was reading it the other day, they said about 83% of data projects fail at a lot of major companies. And a lot of that is because people don't have data literacy overall. They go into situations um, where they're not necessarily looking to solve a specific problem with the data. They're more so they go into it with, okay, we have this specific. We're going into it not looking at what can we do, what should we make based on the data, right? They're looking at it. They're trying to reverse engineer it. Like, hey, we want a dashboard that shows this, that, and the third, and go ahead and put the data in to do that and go ahead and analyze the data and structure it and all of that to do that. Where so the approach should be we need to solve this specific problem. And then once you start structuring and analyzing the data and doing whatever you may do with the data, then you find um, the appropriate pathway to properly utilize that data.
So I think like for me, when I take a look at it, I just try to look at the brilliance of it because I have an affinity for data and data research and data science, although that's not my forte. But when I look at Edward and then this new kid that's on the block, Michael Mays, Dirty Goth Boy, I think that them playing in the casino realm, and that's why I said popular culture. Those are unregulated markets that they can actually go into and test their strategy. I think for me, when I look at it, because I look at this Michael Mace kid, I watch all of his TikToks, and he's going and getting the young kids and the little babies and all of those people and say, hey, I see you betting this, but why don't you try my strategy, right? And I saw one with little baby. They went and sat down at the baccarat table, and uh, 24 out of 25 hands they were up, right, against the casino, and it's gotten so important for him that casinos have banned him from actual live play. He can play in poker games, poker tournaments. He can't play in blackjack tournaments, right? He can't play in baccarat tournaments, but he can play in poker tournaments. But he could also come to the table with somebody to consult them on what the plays are. And I think that I find it very interesting. I think we'll get into some of my theory on this later in a different market. But I actually like these guys when it comes to them being who they are and then later becoming market makers and having market maker strategy because you got to kind of fit the bill and understand where you can go perfect your strategies and you're not regulated, or you could be placed into an industry to where it causes you necessarily trouble with your reputation, you know. So
Right.
one of the videos that I watched on this Michael Mays guys, he kind of alludes into how he's making the money that he's making. So he actually has very wealthy investors that will call him for a weekend in Vegas that put up, 10, 20, 30, 40 million dollars, to go and play with some of his algorithms. But from a popular culture standpoint, he's the bad boy. He's got all the tattoos. He's got the porn stars. He's got the McLarens and the big watches and chains and stuff like that. And I don't think people are seriously delving into the science that he's using to play these casinos. It's kind of
And
good.
I'm so happy that you said that, especially when you mentioned market makers and what he's doing. He's essentially operating somewhat like a hedge fund would operate.
Yep.
And it's important to say that because when we talk about the company of the week, Citadel LLC, and we just talk about a lot of these hedge fund
Let's get
managers and portfolio managers in general, a lot of them come from a poker and blackjack background. If we're talking about Carl Icahn paid his way through Princeton based off of poker. If we're talking about Ken Griffin, who is the CEO and chairman and also founder of Citadel, same thing. He paid his way through college through gambling. And the biggest thing about why I think that little goth boy dude he might be receiving, how do I put this? He might be receiving more success if you just look at it on a statistical, like percentage risk return basis, than a hedge fund is because when you look at it, when you look at what you're doing when you're gambling, it's essentially stochastic calculus, meaning that your outcomes are randomized. But with that being said, there's a fixed amount of variables, there's a fixed amount of outcomes that may happen, which makes it when you're taking a stochastic calculus approach to things, that would make quantitative methods a little bit more effective there than say the stock market, for example, where it's a complex adaptive system and not all of the outcomes are fixed. So I think that's why sometimes you deal with people being banned in that capacity, but being able to go to the markets and not necessarily being banned.
There's a movie with Ben Affleck and what's the kid name? They do movies together. They both from Boston, but it's not. No, it's Edward Norton and the guy who plays Jason Bourne. What's his name? Uh,
Matt
but
Damon.
Matt Damon. So there's a card game, and this kid is paying his way through law school on the same type of modus operandi. And then if you watch the movie Boiler Room, it's the
Yeah.
same. It's the same type of deal. And I just hope that people in the general public stop letting things like that go over their head. Like when I started paying attention to this Michael Mays guy, I really started paying attention to his personal interviews. And so he makes mostly TikToks, but there are a couple of YouTubes. But I did a deep dive on his TikToks to like really listen to his story and what he was doing and understanding that hey, this guy is really a hedge fund operating in
Mhm.
Vegas.
And
And
what's so crazy about that is prop firms like
yep,
a Jane Street or like a Hudson River Trading,
hmm
they view those people favorably to
yep.
the point where in recruiting and things of that nature, you'll actually you actually have a sustainable, not sustainable, but substantially higher probability of getting hired if you show those skills because it directly correlates so much.
I think these methodologies directly correlate into the topic that I think DJ wants to talk about a little bit later when you look at the crypto markets and the correction that's going on right now, because it's really a similar aspect. But I mean, whenever you guys are ready to jump into that, you
um
know,
also we're gonna have a clean transition into it because like how Jay mentioned that aspect and also the incorporation obviously part of why I wanted to let go out build up into it because all of this timeline wise these are previous things because that look where the crypto market got where it is. And like it was really casinos and stock market back then. Now we're here with the cryptocurrency, but we also see like companies, and then also like how long it took to be able to build out Citadel to where it is today. That's another thing. much time and effort it is an overnight process.
You're breaking up for me on this side.
You said I'm breaking up.
Yeah.
Yeah.
Can you hear me
It
better?
might have been your distance.
Yeah, it's your proximity to the mic.
Yeah, I gotta get closer to my desk. But it's the noise cancellation feature. But just seeing how long it takes in order for an individual to be successful in these rounds, it's not overnight processes, and you have to learn to be okay with putting in the work in order for you to have a Citadel. Also, like what Citadel means to the market. So I want to know what both of your perspectives of Citadel today. Where, yeah,
I mean, you're familiar with my perspective.
conversation after that.
Do you want to start, Jock?
Yeah, so I'll just get straight to the point. Um, so obviously, I'm not a fan of certain classes of people given the legitimacy to rob, but I'm not mad at it either, right? So in our culture, you know, we definitely have monikers for certain people who know how to manipulate certain algorithms and also industries, and we tend to name them scammers or swipers or things of that nature. And so when you look at the larger corporations that are allowed to play in areas like that to manipulate data, I'm just not too fond. I'm not too fond of that personally, because all of us aren't allowed to play in that realm, right? There's a very fine line if you don't come from certain backgrounds, that you have to tread in order to play in that arena. And I just need to presuppose what my next statement is with that preface. So I'm not mad at the game, right? Um, and I'm not mad at the players either. The ability to parse data and manipulate markets in artificial economies are par for the course, right? And the general public needs to start to understand that currency in the new market is no longer fiat in its general sense, but currency in the new artificial economy is 100% data and the analytics that it's based upon, right? So your ability to bring in enough information on certain topics and how they stream in a particular industry can now start to set the precedent of people being able to hedge against leveraging, right? And that's how wealth is being created. If we want to talk about current day inflation, right? Current day inflation is really based upon um, large companies or corporations inflating their prices to the general public based upon shock and awe and trauma in the general market. So a lot of companies were able to raise prices during the pandemic because it was necessary. There was, something awful going on, and we should raise the prices and charge you more money because you still have to buy this bullshit anyway. And then thus and so forth, it created inflation because of the quantitative easing and the amount of money that was being dumped into the economy to, I guess, shore up, people on the bottom's ability to purchase these products. And this is the game or the story that we're being told on the front end. But what's being happened on the back end is the speculation uh, and spending and buying habits of the average consumer and where these funds are being funneled, right? So then the larger companies are able to raise prices, pull in the dollars, and those profits are 100% going into stock buyback programs, right? And then when you're purchasing back the stock, the larger stockholders are the ones who are benefiting necessarily from the wealth pool that's now being created. Companies like Citadel are the bird dogs on the back end to create those markets, right? And to help corporations and large accredited investors large-scale accredited investors and investment firms to bird dog the information and to manipulate those markets so those people can, generate a larger portion of wealth store, right? So that's my 2 cents on hedge funds and large investment companies. I'm just not a fan of them necessarily. I'm more of a power to the people when it comes to the economy.
Brother Jay, what what you have to say about you actually was the one who had brought them to my because of the way how I looked at it. There are the companies that the average individual knows about in the public,
right?
Even Berkshire and Hathaway, because Warren Buffett is somebody who put out in the public, and Tesla. So.
Buy wonderful companies at great prices. Yeah, I mean, it's not wrong, but it's not wrong, but the simplicity in which it's stated is a little bit facetious. And I'm not mad at him either, because that's what he gets paid for.
Can we go to the comment, not to cut you off, Jay, but can we go to his comment when he says, I buy companies like Coca-Cola and M&M Mars? Like, people are always going to buy Snickers.
Yeah. I mean, he's out there acting like he really likes BQ. So how much can we believe him? You know, it's a lot of.
He eat McDonald's every day.
Yeah. It was Wendy's, I think. I think he had a position in Wendy's.
He owned McDonald's.
No, Bill Ackman was the one that was in Wendy's.
Yep.
Yeah. Yeah, Bill Ackman made up pretty good on that Wendy's deal too. I can't lie.
Fighting the difference between like a Berkshire Hathaway and a Citadel. But go ahead, bro. I want you to give me your views on Citadel.
So first, to highlight the difference between the Berkshire Hathaway and the Citadel, Berkshire Hathaway largely takes a value investment approach to things. When you look at Berkshire, you're talking about, it's essentially an insurance company. So the way that is evaluated is a bit different than the way that you would evaluate a hedge fund. And that you, first off, you would evaluate their progress through book value. And a lot of the secret in what Warren does outside of just great value investing is the way that he structures his capital, specifically his collateral. When you talk about free float is actually when you're structured as an insurance company, the free float itself is seen as a liability. So that's already a tax advantage situation when you're talking about the returns that he's generating off of that free float. Also, when you look at the fact that in Berkshire Hathaway, Warren's also known to buy other insurance policies such as viaticals and life settlements as well, bank-owned life settlements specifically. It's just a great collateral base to have that a lot of people aren't privy to. And a lot of people, if you're not an accredited investor or sometimes a qualified purchaser, you wouldn't necessarily have access to. So when you look at somebody that has that their collateral base is something where you're buying into it with a contractually guaranteed about 25% return as far as just absolute return. And then also you're getting a 95% LTV on that collateral base. It's built for you to scale very quickly and efficiently. So I think a lot of the secret in what Warren does outside of his investing fundamentals is in his capital structure, which is world class, if I do say so myself. Speaking about Citadel in specificity, Citadel is more so a quantitative firm. A lot of the methods that they use are quantitative. They do a lot of high frequency trading. Citadel, a large part of their advantage is the fact that Citadel operates a market maker, a hedge fund, and also a dark pool at the same time. So Citadel Connect would be the dark pool. The market maker would be Citadel Securities, and then I believe the hedge fund is just Citadel. Don't quote me on that. Citadel Advisors, I think it is. Don't quote me on that. I'd have to recheck. And with that being said, typically, if it was just somebody as an individual entity or as an individual person, that would be seen as a fiduciary breach of duty because you're essentially occupying multiple sides of the deal at the same time, what with being a market maker and a hedge fund. Um, Part of what makes Citadel so powerful is they were one of the first people to get on the board of payment for order flow. And it's actually interesting because before Citadel used it, Ken Griffin, he actually wrote a letter to the SEC detailing the dangers of payment for order flow and suggesting that the SEC ban it. Once the SEC did not do that, he did what I think any prudent investor would do, and that is capitalize on his edge. So they deal very heavily in payment for order flow. And even if you look at the brokerages that a lot of the retail markets go to, because a lot of people don't realize the majority of capital in the market is not institutional, the majority of it is retail. The issue with retail is that they don't have the skill set or the information to properly gauge the inflows and the outflows, the sentiment analysis, and just the overall scope of what's happening with that capital flowing into and out of the market. So a lot of their brokers they are trading. I won't say trading against you, but they sell your trade data to people that are trading against you, and these people have algorithms to profit off of that via high frequency trading very quickly and very efficiently. So it's essentially the same model as per se a Walmart. When you look at them, they're doing high volume, small margins. So if Citadel's the market maker and they're fulfilling about 60% of the overall trades on the stock market on the lit exchanges, then you can already see the informational advantage there. And when we're talking about payment for order flow, if you look at Tasty Works, Robinhood, Webull, TD Ameritrade, Schwab, Merrill Lynch, Fidelity, unless you turn on Fidelity Direct Routing, almost all of these institutions use payment for order flow. So almost all of your data, once you're being made, is being sent off, and they're able to essentially front run you. Not necessarily front running legally. I don't want to make that accusation for obvious litigatory purposes, but in practice, essentially you're being front ran. And because they have the machines and supercomputers in order to do that at a high efficiency, we're talking about millisecond transactions. It's a lot of profit very quickly, and it's a lot of profit without much risk, if we're being honest about it. Um, a big thing to say about that too, when you look at how it operates, they also operate a dark pool. So if you look at a lot of the things that aren't being fulfilled, right, or a lot of the things that might be non-beneficial to their positions, their more longer-term positions, are actually being routed through the dark pool, which is Citadel Connect. And the problem about the problem with dark pools, if you're a retail investor, is that it stultifies price discovery. And the reason that it stultifies price discovery is because this is being routed off exchange. The original purpose of a dark pool was for large institutional scale investors to be able to enter and leave stocks without affecting the underlying price too much. What's happening is that dark pools are being used for investors that are not large scale. It's being used for common retail investors with lower with lower assets that they're trading essentially. So when you look at it, there is stocks that show up on a lot of these high frequency trading firms and these payment for order flow users books. When you look at their 13Ds, Fs, and Gs, specific investments that they're in, if you look at those investments, a lot of them have highly irregular dark pool volume. I'm talking upwards of 60 to 70%. So when you're doing that, and what's happening in a lot of those situations is buy orders are getting routed to dark pools and sell orders are going through on a lit exchange, which completely falsifies price discovery if we're being honest. Also, failed to delivers, which is essentially when you have a derivative contract, right? Specifically options, um, and the position ends up being against you or in the money for the counterparty. What's happening is that these shares aren't being delivered, and the failed to delivers, the FTD, so to speak, are being warehoused and moved around because a lot of the most important metrics when you're looking at the new paradigm of how a lot of trading and a lot of market making is being done in the markets, a lot of the pertinent information is being self-reported. There's no outside entity to verify the validity of the numbers that are being reported. So you're getting things that mathematically don't make sense happening in the market. Like companies trading 57 times their float in a single year. That's unheard of.
So, Brother Jay, with that being said, how,
Mm-hmm.
and also to you, Brother John, as well, how are these type of setups such as dark pools, how are these affecting today's inflation? And then we see these large companies presenting themselves into the crypto realm. And
Before we get into that, I want to ask one question to
go
Jay,
ahead.
just on his opinion. So we were talking about front running, and we don't want to be accusatory in any of that. What's your personal position or opinion on Ken Griffin's role that he played in the whole GameStop short squeeze?
um, I feel I feel like if you're looking at it from a purely business aspect, he didn't do anything wrong as far as him operating as a fiduciary to his institutions. Um, Maybe the naked short selling, um, which has yet to be unequivocally proven, but it seems highly probable. Maybe the naked short selling is the issue, but if you look at it, a lot of the issue actually goes to the brokers. The brokers are the ones that have the fiduciary responsibility to the retail trader, not Ken Griffin.
Yeah.
So his role in the GameStop debacle, he certainly didn't help it, but he wasn't the only one to have that position, and he wasn't even the largest. If you look at Susquehanna had a substantially larger position than Citadel in that short play. And I think a lot of those companies in general, they've been able to. My issue per se, and I'm slightly biased here, just because this is the capacity that I wish
Yeah,
to
that's why I
operate
asked the
in.
question. Yeah,
Not
that's why.
not necessarily using the same practices, but
Yeah.
it's just the capacity that I wish to operate in. So looking at a lot of them, I think that they have negative effects on the fundamental companies that these things are being happening to when you talk about bust out schemes and things of that nature. I think the problem with situations like that is that a lot of these large scale short selling positions, because GameStop and AMC they're not the first ones where this has happened. I think they're the first ones where there's been this much awareness of it. And because there's this much of awareness of it, it's now become a drawn out situation. So I think overall the issue is that when you use these practices, essentially what you're doing is you're stealing market cap from companies, and you're giving it to their competitors, because a lot of these profits from short selling positions and things like that, and a lot of these I won't say abusive or manipulative, but more so a
Yeah.
lot of these strong-handed tactics that are being used. Um, a lot of these tactics that are being used, they effectively the profits from them effectively go to companies that the shorting institution is long gone. So when you and I find it very peculiar, to say the least, that a lot of the companies that are having such unprecedented short activity are also acquisition targets of the same companies that a lot of these shorting institutions are long on, which is essentially the crux of what a bust out scheme is. So I think that it has detrimental effects on the market as a whole. But if you're just looking at the fiduciary capacity of things, Ken Griffin hasn't per se done anything wrong. The morality of it is subjective.
Yep.
Excellent.
Of course. I'm not trying to put you on the spot, Jay. I'm bullshitting. I was trying to put you on the spot. But it's a great segue for us to go into the crypto space, which I'm kind of bullish on the pushback of these bust out schemes. And so let's talk crypto. Um, so the market correction in crypto is what public facing, the general public is the terminology is what's going on and what people understand it as. But in my opinion, the the shorts inside of the crypto market are real reminiscent of CDOs, right? Because you don't have CDOs in crypto, you have CDPs, right? So collateralized debt positions, and it's basically the crypto goes, comes from your wallet and goes into a particular holder that you can now go and take a loan, right? And so these big DAOs are being created to say or speculate what the LTV is against your crypto holdings, right? And then this smart contract is created, which creates the CDP, right? And it's very eerily similar to the CDO market. And this kind of backtracks into my earlier conversation on market makers like Edward and Dirty Golf Boy, understanding how they can go into the casino realm and be market makers and test out their strategies. I feel that the Citadels and the BlackRocks and the Blackstones and the Bridger Capitals, all of those companies came into the crypto market because it's unregulated. And they're like, it's the Wild Wild West again. Let's get busy. What are your thoughts on that?
I'm not familiar with Blackstone being in on that. That's news to me, but I wouldn't doubt it. I am familiar with, I believe, Two Sigma being in on it though.
Yeah.
Um, I don't, I don't know. I feel a couple of ways about it. I think that a lot of what's going on with crypto is actually reminiscent to the Pacific, the APAC crash of '87, and also the dot com crash of '99 2000, which is where you have situations that are because where you have, and this also applies to the general stock market as well. When you have when you're coming off of a business cycle or a credit cycle, so to speak, where essentially money is being given away so irresponsibly, and credit is so widely and easily available, and you're able to rehypothecate certain assets so many times to the point where a lot of what fueled the markets is leverage, not necessarily fundamentals.
Yep.
So I think the crypto correction is more so now that it's a bear market. You find out who's swimming naked when the tide comes in.
Mm-hmm.
So the tide is coming in now, and we're seeing that a lot of people are swimming naked, whether it be there's no use case, or a lot of times you have projects that are a solution in search of a use case. You have projects that have no tangible option for sustainability in the future. A lot of them now are being looked at from a more fundamental lens versus a more speculative lens because the credit cycle is crunching, what with the Fed raising the interest rates and just capital not being as freely available as it once was. So a lot of what was driving the markets before was margin and leverage. And what we're seeing now, and why these liquidations that you're seeing are so large, these flash liquidations that are happening in 2 to 3 hour periods or overnight periods, a lot of the reason why those are so large is because margin calls are happening. Because a lot of what was driving the crypto markets was over leverage. So I think it's just a connection to, I think it's just a correction to projects with actual tangible use cases will have fair, they'll have fair price earnings multiples, so to speak, or fair, just fair multiples as far as what you're paying for the actual things. If you look at some of the market capitalizations for a lot of these crypto projects versus what they actually earn, it's astronomical. The shit makes no sense.
Yeah.
Pardon my French.
So like a Bored Ape Yacht Club, right?
Bored Ape Yacht Club,
over leveraged, over capitalized, no utility.
Bitcoin, Ethereum, a lot of blockchain based projects in general, they're not doing enough tangible business outside of the crypto thing, which effectively operates similar to a Ponzi scheme. I don't want to necessarily call it a Ponzi scheme, but
it's
it's
okay
very
to say
similar.
that. It's okay to say that because and the reason I say that it's okay to say that is because kind of my thoughts on it, right? So I obviously we've spoken personally. I kind of understand what your take is on crypto. Um, I'll kind of clear it up for you here. I feel exactly the same way when it comes to a Bitcoin versus an Ethereum versus a Solana, right? So I'm more bullish on an Ethereum or a Solana, but out of all of those, a Solana, because you get down to a drill down um, technical utility. Like, so Solana is very bullish on taking their payment API and putting it in actual stores. Like they want to position it the same way an Apple Pay happens. So there's a real utility as opposed to a Bitcoin. What the hell do you do with it? Right?
100%. And then also the technology protocols that they're being built on aren't sustainable.
Yep.
When you talk about the customer acquisition, the more customers that they acquire and the more usage that they get, they become more expensive to operate, and the energy usage becomes more, the energy that's available to be used becomes more limited. And you've seen, we've seen the precipice of that, not necessarily the full, just the tip of the iceberg, so to speak, with Ethereum and their um, their minting fees and things of that nature.
Yes.
Their fee structure is due to it not being a sustainable model because the amount of throughput that you need to operate a blockchain where every single computer on there is verifying it, it's just too much compute power
Yep.
for it to be used at scale the way a lot of these projects are conferring that they may be used in the future. And I think a lot of the valuations that they're being given are based on the ability to use them at that scale. And
So
also to speak on Solana, another thing that I wanted to mention with Solana, I'm not sure if you're aware of it, but Solana through Solend, recently they actually tried to take custody of a whale account to stop them from selling out, to stop them from collapsing the price of the asset.
yeah, of course. Yeah, very aware of that. No, when it comes to those specific practices, I'm not necessarily bullish on because a lot of these companies come to the market and say that they're DeFi. But let's go back to layer zero, what you were talking about when you're talking
Let's
about
talk about it.
throughput infrastructure and all of that. So just like there's, in the finance realm, there's truth in lending. Should there be truth in technology in the crypto space and people being forced to actually admit that their technology is not blockchain, but actually distributed ledger technology? And then the issues with peer-to-peer distributed ledger nodes and bottlenecking and the ability to scale viable use cases that they purport to be able to participate in? Do you believe that they should actually reveal what their real technology is as opposed to?
I feel like that's kind of what's happening right now with other governments that regulate some capacity because like it is the wild wild west right now. and without no policy or regulation, people literally have the ability to put forth and say whatever it is, because we have people marketing metaverses that are not metaverses, and that's no difference than people offering certain particular, like NFT projects with no utility, cryptocurrencies that are not asset backed. It's just like literally they're crypto utility. So I do feel as if it's beneficial for a level of regulation, but I still want to see DeFi be DeFi if that's possible.
It's not.
It's
It
not
sounds good
you.
in theory.
Yeah, you.
Said it
Yeah,
like
you
I
can't.
mean, when you look at what a lot of these projects are doing recently, they're essentially operating very similar to how a central banking authority would operate, as far as, for example, what Solana did, and even when you look at what Binance did recently, where where I think they bought $2 billion in Bitcoin over this past weekend to try to stabilize the price
Yep.
because it was falling. It's very similar. How is that different than what the Federal Reserve does as far as quantitative easing and injections into the economy? I mean, and even when you look at these, a lot of, if we're being completely honest, a lot of these projects are securities passing as commodities,
Yep.
yes, and that's
and they should be required to put out a prospectus.
that's exactly why the SEC is trying to step in right now at this point, because remember we spoke about this previously, like months ago, like possibly last year. It's a thin line that has you between crossing that security line and then the SEC being able to come in and regulate, because if you're saying that you can if you can make any money off of utilizing this particular currency, if you in some cases staking it, that puts you in SEC regulation in the United States jurisdiction.
So here comes my pushback, because I mean, I'm not a finance guy, and I'm not a creator either. I'm if I want to get to my roots, I'm a hacker, and I come from open source communities, and so I hate the talk of regulation or the speak of regulation, but I also hate the modeling of DeFi and backstopping it against centralized finance. So I think the thin line only gets tread when you bring fiat in as the backstop or the on and off ramp. And I think that people are so uh, far behind in ingenuity and imagination on how do you make crypto valuable without securitizing it inside of a fiat realm, right? So people don't understand that process and understand that that's a process that's going to take years. It's not going to take months, right? And so that's where you tread the thin line of things becoming regulated or things acting as securities versus commodities, because the general public's view of value is something that's not securitizing itself, right? So, yeah, I don't want to get too deep or esoteric into monetary policy and what brings value to fiat currency. But at the end of the day, I think the problem in the DeFi realm is people desperately trying to onboard the general public into the space uh, took the easiest route from the low hanging fruit and backstopping and onboarding and off ramping people through fiat currency. To me, that's the largest issue.
To speak on what you said, I agree. As far as I'm not necessarily big on the regulation of the technology per se, but I think the making of these into currencies, which essentially function similar to a SPAC, where you're doing this to avoid, because all of these currencies, they're being offered by companies, actual companies, but they're going the currency route to avoid having to do an IPO and avoid having to do disclosure, because they know that there's a level of facetiousness under the things that they're selling themselves as, and they don't want to have to give people proper disclosure, um, as far as to what they're doing, either via prospectus or via a memorandum, um, that you would typically have, and that's something that you see a lot with specs. as well, where they'll go ahead and they use a spec to onboard companies into that public equity market, so to speak, where you're getting equity funding in order to perform your duties without giving full and fair disclosure, or at least not to the full extent of other companies that they would.
So yeah,
So,
I definitely agree that Bored Ape should not be treated any different than the what's the company that made the fake electric semi vehicles, and they went the SPAC route. I can't remember their name, but they were trying to compete directly with Tesla. The guy said that he built a completely electric semi truck, right? And then he actually paid developers to like tow the truck up the hill, and then they let it roll down the hill and filmed the video. And he raised hundreds of millions of dollars saying they had, but he used the SPAC in order to do an IPO. So I think that's my entire pushback. Like, so I'm more of a fan of crypto being a currency for governments that want to detach from fiat currency, right? So if we just look at finance or economics in its general fundamental sense, right? A market is two people who want to exchange, and money or currency is the medium of exchange, right? So if you take these third world countries that have resources, so let's just say the Congo and coltan, let's just say Brazil and bananas, any of these uh, second and third world underdeveloped nations that are relying on the world or central bank for fiat finance, and then the IBS in order to trade that with other nations. Usually they're colonizing nations in order to distribute consumer goods to their general public. I think this is an off ramp scenario for those particular countries.
and a lot of my issue with the handling of things with the SEC, specifically their suit against Ripple, is that for you to have companies that serve that purpose, which is what distributed ledger technology should be used for to begin with. It's not a fix all for everything. It's a fix for situations where you would typically manage a ledger within the general course of your business.
Yep.
So it should be used for remittances. It should be used for cross currency or cross national bridge payments. That's the
Yep.
perfect use case for it. So when
Yep.
you look at projects like Stellar Lumen or Quant and the interledger overledger projects and things like that,
Yep.
or if you look at Hedera or a Ripple, for example, these are accurate uses for it where it's not operating as a security per se, but it's meant to operate more so as a commodity or a currency, so to speak. It operates similar to a bond, if we're being honest.
And to your credit, Ripple and Circle are the only two cryptocurrencies at Davos.
Yeah, I mean, and when we're talking about these two, we're also talking about um, specific projects that their messaging format their messaging format is compliant with ISO,
Mm-hmm.
which for those who don't know is the International Standards Organization. So the International Standards Organization handles a lot of the messaging formats for information to be passed between SWIFT members, so to speak. So when you deal with them, they're having a new messaging format that they're looking to roll out called ISO 20022. So when you look at those ones that are specifically listed, they're the main ones that are actually ISO 20022 compliant. And my issue with that is that Gary Gensler he taught a class at MIT on blockchain and distributed ledger technology and cryptocurrencies in general. So he's very aware of the distinctions between different situations and the distinctions between what would be a security and what would be a commodity or a medium of exchange that's not operating in the same capacity as a security or is not operating necessarily as a speculative instrument. or at least that's not the primary purpose of it, is to operate as a speculative instrument. So I find it very odd that he's the one that's leading the charge, and I don't think it's a winnable case. But yeah, that's my opinion on it. I just think a lot of companies, a lot of these crypto projects in general, they should not be allowed to be cryptocurrencies. They should be companies, whether they're traded privately or publicly. The companies themselves should be traded, and full and fair disclosure should be given on the underlying technology.
So there should be prospectuses and private placement memorandums for
Yeah,
people
and
who
you can regulate the inflow and outflow, right? As far as how it's operating as a financial instrument or an asset without regulating the actual use case.
yep.
Okay, so that leads to my next question. With the particular technology and direction we are in back, especially because this is a trust fund baby platform, like of our complexion, like mainly
You in the matrix, bro.
yeah, this is melanated individuals who are asserting themselves are already established in these particular realms. So I feel like it's important for us to lay the foundation. Like, how do we properly assert ourselves into these particular realms? And with us expressing all the way out what proper way as a cryptocurrency, if you're trying to start up, if you're like one of us.
I mean, if you're just talking about people trying to leverage off of it and create a better situation for themselves, I would say take advantage of the lack of regulation while you can. Just to be completely honest with you, obviously without being fraudulent. Um, take advantage of the lack of regulation while you can. I think even if the SEC does lose this Ripple case, I think over time there will be more heavy regulation of these currencies. And ultimately, if people still do use distributed ledger technology, it'll take more so of a private or consortium chain model that they use to manage and that they use to manage the ledger amongst themselves or amongst their business partners, more so than
Which is already the use case with Ripple. So you got Amex using remittance,
right.
loans and stuff like that.
So with that being said, well, me personally, my perspective, I propose this.
My brother, you in and out, and I know you dropping game.
Do currency situations, and things like where they fall short, where they can't crypto market do open up and proposal of them is offer it because it doesn't put you into that liquidity volatility when you to pull money from that currency because that needs to pull. I feel important for our people to understand. Like we don't understand cryptography and blockchain technology as of yet, as a whole, and it's important for us to start coming into these understandings. Brother Jai, you got anything about that?
Yeah, I couldn't really understand what he was saying.
I was breaking up.
Yeah.
So I was just saying that it's imperative for us to assert ourselves into these particular realms. And what I was expressing at one point in time was that to another individual that instead of them trying to leverage off of the cryptocurrency, they needed to associate some type of, use case. In this situation, I presented an NFT because it doesn't put the currency into a position of volatility that they're, by jeopardizing the liquidity pool. Because if you're gonna try and leverage off of your currency in order to, live off of, you're killing everything that you're making unless you've established a situation where you have some form of staking and then you are possibly putting yourself in a situation where the SEC can step in. So we dealing with thin lines.
So I think kind of my opinion on the current use case of of NFTs. NFTs are a security, the way that they're being used, right? So I'm actually working on a project privately that I got to speak to you brothers about, NFTs as a service, right? NAS. So hopefully the world heard it here first, right? But outside of, I think, some of the thought processes that I kind of have, NFTs are securities, and um, I would have to be 100% in agreement with Jay. There should be private placement memorandums and also security agreements, subscription agreements put in place to purchase a board ape, to purchase a DGOD, because there's no real um, utility outside of the synthetic derivative, and the floor pricing, and me being able to trade that, inside of a very closed loop network, to generate the income off of futures, options, and shorting strategy, right? So let's just be honest. That's really where most of the wealth was made in the NFT realm. Now, when you come to specific businesses that have the ability to sustain themselves into the future, and then these NFTs are um, securities used to raise money to transmit this utility. Yeah, it's a security. I don't know that there's another way outside of understanding what that is for future regulation. Um,
With that, I'm just saying it protects the volatility of jeopardizing the liquidity of the cryptocurrency that you're gonna be putting forth. So I recommend having both.
that's assuming. So I've made a post in reference to the life of the Negro that I said, with the current market correction, that I kind of wanted to shift uh, my rollout of the actual project, because at the end of the day, you know, NFT projects are a fund, right? NFTs are a security, and at the end of the day, I'm an asset manager, right? And I said that specifically after very long conversations with you, very long conversations with Jay, very long conversations with people who work in the securities industry about, in general, what these projects are. So, to your point, that depends on the mindset of the actual NFT leader, project leader, right? Because the volatility could still exist if the NFT offsets the liquidity pool of the token, if the asset manager employs particular strategies for it to be volatile on purpose, right?
I understand completely. Yeah.
Yeah, I mean that's what's going on with DGods right now. So let's just break down DGods. So DGods is an NFT project with some dope ass art, right? And I might buy a DGod now since they're so fucking cheap, because I like the artwork. But DGod has an adjacent token called Dust, right? And then they say that Dust can only be used inside of the DGod microcosm to purchase merch. Um, Real bullshit utility,
Kind
right?
of like Bitcoin.
Yeah, yeah,
Yeah, just like Bitcoin. I got you.
yeah. So ApeCoin modeled themselves off of DGod's Dust model, because kids were buying $600 hoodies. Once you translated the value of Dust into fiat currency, hoodies were costing $600. T-shirts were costing $300 to $400. Stickers were costing $100 a piece.
You coming the new Gucci and Louis off crypto now.
But no, not at all, because the quality's not there. Not to say that
I'm talking about
Gucci.
like, yeah.
Yeah, yeah, but I mean, that's all of that's a farce, right?
But not on not with spit on it.
Yeah, exactly. But all of that's a farce. So I mean, they're market making, right, with the security, right, and a securitized instrument, and they're creating their market making, right. So all of those type of activities should definitely be regulated by the SEC, because and then you have kids that are participating in this. So you have kids that are under the age of 18, that happen to come from affluent backgrounds, that give them the ability to either already be generating a credit score, enough for them to pull down leverage liquidity, right, to put into these type of assets, right, without even questioning their parents. So, I mean, I know at the time when I was in high school, I went to school with kids whose parents had them on as authorized users around the ages of 16 or 17 on their credit cards. And these kids had 750, almost 800 credit scores based upon, what their parents were actually able to participate in. So these kids could actually go inside those, and they have been. These are some of the discussions going on some of these Twitter spaces. These kids, maxing out credit cards to buy D gods and board apes and stuff like that. So you see a kid that's 17, 18, 19 years old that's got $4 or $5 million worth of NFT liquidity. They bought at the right time and they're speculating at the right time, but you run the risk of children being harmed in a financial capacity. This shit needs to be regulated, at the end of the day. Yeah, that type of activity. And that's not necessarily my take on crypto, but yeah,
I
I'm
just
gonna jump
need
into
them to wait
Marco's side
until
real
I've made my money. Then they
quick.
can do what they want.
All right.
Yeah, exactly.
But
Yeah.
we right now, the U.S. has been for a long time is a debt wealth society. So, man, that's intriguing because like I want people to be safe, but I'm not trying to cross myself out. You feel me?
No, I'm not saying that you crush yourself out. I
No.
think everybody on this screen is playing the game until the game can't be played anymore, all the way, to the final seconds of the game, right? We're gonna shoot that free throw when it's 1 second left on the clock, But at the end of the day, I'm just not a fan of how the people who front ran the whole NFT crypto space in the last 3 years, put the market together, because you brought a lot of heat and attention to something that was,
Okay,
below the radar.
let's compare, and then
They made the block hot.
maybe that's part of the learning curve because when we look at Bitcoin and then we look at how we got Ethereum and Litecoin and all the secondary other ones that came afterwards, we see a slight progression. That's usually what happened when you're first to market. So maybe this could, even though people coming up off of it, of course it's a learning curve. In some situations, if they knew better, of course they possibly would have done it if they seen the benefit in it. And that's what I feel like we getting a lot of because, like you said, in the last 3 years of the NFT market, we've been seeing a lot of terrible business mainly. And I feel like that can be attributed to just because people don't know the technology or the capability of it just right now. Because if they did, they would be moving so differently. They would be moving like how we moving.
I mean, you can say that, but it's very similar to. That's why I said it's very similar to the 87, 88 APAC crash, and it's very similar to the 99, 2000.com bubble,
Yep.
where, I mean, if you want to extrapolate the key factors or the key figures of the situation, the influencers are very similar to the venture capitalists.
Mm-hmm.
Yeah.
That are giving obscene valuations in the seed round.
Yeah, because how the fuck
Um,
the $4 billion valuation?
when you're not turning a profit, right?
Mm-hmm.
Yeah, I mean, at this point, it's irresponsible, but at the same time, the market is in a place for suckers. You come in and you come in with a speculative mindset, and you come in as a speculator with short-term goals for it. It's like Warren Buffett said, the market is great for transferring money or liquidity from the impatient to the patient, and that's what we see happening now.
Quantitative tightening is about to separate the men from the boys, fellas. The
I love a
people,
good bear market, man. I do.
exactly.
It's it's something in my spirit that just, I mean, I can make money in a bull market too, but a bear market is just so sweet.
Yeah, the largest transfers of wealth comes from the bear markets. The new, you know, we're not even in the billionaire realm. Like, who are the new trillionaires? Everybody's racing to a T, right now. And that's the new gameplay. So if we're not talking billions, and even in our private discussions, then we're in the wrong conversation. And bear markets are where those people are created, and quantitative tightening and the lack of access to free and loose credit is what really makes men, right? And it separates those who had all of the impatient get rich quick schemes, right? Long term businesses based upon fundamentals is where it's at, right? And use cases with these particular technologies uh,
So,
is where it's at.
I might say for sure, I appreciate y'all for coming on. I do have one final question before we close out. Where do you both see the market going in the next 12 months to 3 years? Like, where do you see it?
I'm bearish on the market. I'm being honest. I think the correction isn't complete yet. I think the correction still has quite a ways to go.
Yep.
If I'm being honest, especially in a lot of the securities, or not securities, but a lot of the cryptos that people seem to be very fond of, specifically those based on a blockchain type of model. I see a lot of them having very, very drastic decreases. I see Bitcoin definitely going sub 10,000. And even going further, I see it going sub 5,000 longer term. I also see Ethereum losing another 50 to 60% of its market cap. And I mean, you make that look, but when I gave you my thesis on Bitcoin in November, since then, Bitcoin has lost 60% of its market cap.
Bro,
so we're seeing it in fruition.
I agree. It's just hearing you say it, I feel the shock value of a holder right now. Like, damn, if I'm watching this video and I don't listen to that information, where would I? That's all I'm thinking about. Because shit, I'm not holding no Bitcoin. I know better.
So let's just be honest. Ethereum is a 3-digit cryptocurrency, right?
With that being said, I'm bullish on ISO 20022 compliant currencies. Over 3 to 5 year time frame.
Yeah.
Yo, Jay, when we're done with this interview, jump in the Discord with me for 2 minutes.
All right, cool.
You gave me a whole idea on ISO compliant messaging and a cryptocurrency as a remittance idea, just from what you were talking about. We'll jump into it later. My outtake on the market as a whole, not even from the crypto space. I see, so you got the Patrick Bet Davids, and I'm talking real estate. You got the Patrick Bet Davids and the Grant Cardones speculating real estate at a 30% drop. I see it in the 60s, right? So I see a 60% drop in real estate, right? I see real estate markets being turned upside down, right? Because there has to be a severe tightening of loose credit, right? So I see interest rates. I see another 75 or 100 basis points added to interest rates in the next 12 to 18 months, easily. So that's gonna put real estate in the below, a 60% decrease in market cap. The other thing
especially when you look at the underwriting practices for commercial mortgage-backed securities. We could talk about that later.
Exactly. And we don't need to talk about that in a public format. We'd be giving away too much sauce.
Too much, yeah.
And then so in the crypto space, so not just fundamental coin prices, I just think that fundamental technology and use cases are going to be reevaluated, right? So, NFT projects, all of the major NFT influencers are running scared because they don't know where to go. And Gary Vaynerchuk, their daddy, told them, if you don't got a business behind your NFT project, then your shit's gonna fall apart, right? And pardon my language. But listen to your daddy, to all the NFT influencers that might see this. Your daddy gave you great information 2 years ago, right? You paid enormous amounts of money for his crypto conference, and you didn't listen to any of the information. So now you're 2 years out and you had all of this information to build out real projects, and you didn't do that, right? So my speculation is that the three of us on this particular interview are going to make a lot of money in this bear market. I know that I'm going to contribute as much as possible with my resources to make that happen. I see NFTs as a service, right? Not as a security, and not necessarily as a commodity per se, right? I'm real bullish on NFTs as a service, and I see a way for them to be used outside of the current use case, keeping graphics and the way that they pass through wallets intact, but not pretty ass art for bullshit utility. I see NFTs as a service, and distributed ledger technology, layer 0 and layer 1 technology is really where it's at when it comes to crypto. If you don't have an understanding of layer 0 and layer 1, right, and distributed ledger, then you're in the wrong space. The data layer, I mean, that's par for the course. The data layer can always change. You saw that with Web 1, so I'm pre-Web 1, right? So I remember bulletin boards to web browsers to static websites that did nothing, that became social media platforms, right? Early social media being chat rooms, so Yahoo Chat and places like that, and then later into the MySpaces that became the Facebooks that became, and then so as bandwidth
You remember
increased.
Black Planet?
Black Planet. Oh, come on, I got kids off of there. Stop. But yeah. So all of those spaces, right, happening for one reason and one reason only: infrastructure and technology. So bandwidth, throughput, and then actual technology is what we have to see happen inside of the crypto space with distributed ledger, right? So if we think, I'm bullish on LimeWire also. So LimeWire is coming back to the crypto space, but they have the technology. And I think somebody should bring Napster back, because peer-to-peer and peer-to-peer node technology is where it's at. It's definitely where it's at. They have great fundamentals.
Point, looking into some of these re-emerging companies, because the fact that LimeWire is coming back, clearly they have them in the bag. Blockbuster coming back, clearly they got. I mean, you had an offline conversation about something I'm not impressed. But yeah, it's like you got me looking at a certain situation. But
The former CTO of Blockbuster is my current mentor, by the way. Shout out to Chris Moreau.
Yeah, bro, and they realm, and I'm interested to see what Blockbuster bring back, because Netflix still dumb. Good God, that was an actual fight. That was terrible. But I love to see that type of competitive edge in the commercial realm, and I'm really looking forward to seeing these new emerging brands come forth, especially from our people. I just want it done right, so you don't have people trying to come take your money and you get broke down off taxes properly. So that's the reason why we drop in the FAQ line, and we establishing these forums in order so we can have these type of discussions, so we can have a safe space in order for us to build within our own ecosystem, and then so that we can go out and do commerce within the world. So y'all got anything else y'all want to say?
Yeah, I'm good, bro.
But it's for sure, it was a pleasure.
Thank you for having me, bro.
Oh, for sure. You coming back? I'm trying to get your last possibly weekly. Real. Because like even if we like I have you on board for the weekly book, the weekly movie, because you got another book that you want to drop for next week, but I asked you to hold that, and it's just being able to have people insight in these particular realms, such as job, when it comes to the tech realm, way more knowledgeable than my ass. He's been doing it as long as I've been living. You in the finance realm, even though I am big on that shit, you have access to material I don't, and you work in certain areas I don't, because I don't contract in that capacity. So being able to have your insight, it's needed. It's a plus. It's an honor, and you are younger than me, and I don't mind learning from you. I don't mind learning from Ja, and I appreciate you, both of y'all, coming on, sharing y'all intellect with the groups.
Peace, brother. I appreciate it.
Peace, bro. Peace.